Okay, no, thank you. So before I start, I just want to echo the prior comments, sort of for the need for your efforts, of your efforts within the insurance space and really sort of creating a consistent approach to innovation among industry participants. At least from my perspective, that's very important. But anyway, so my name is Edin Imsirovic, and so I cover P&C space at AM Best, and have sort of been recently tasked with helping out lead AM Best efforts to on innovation front. My background prior to AM Best was in capital markets and corporate development, M&A. So the way I've sort of structured the presentation is I was just going to sort of go over sort of just the general rating process for a few minutes, just to give you an idea of how innovation fits in. And then I was planning about, talking about our innovation and how we approach innovation at AM Best, followed with some preliminary results. Does that make sense to you, or?
I
Okay,
think
so
so.
I'll just do it that way. So going to the next slide. So for those of you who are not familiar with AM Best, we were founded 120 years ago, and we're really the only global credit ratings organization that's sort of uniquely dedicated on insurance industry space and insurance-linked capital market transactions. And really our ratings are used as a benchmark to help the financial industry and consumers really assess sort of insurers' financial strength, their credit worthiness, and sort of the ability to honor their obligations. We have over 3,400 ratings. While most of them are in the United States, we have ratings in over 90 countries and offices in US, Mexico, London, Amsterdam, Dubai, Singapore, and Hong Kong. So on the next slide, you can see that AM Best ratings are sort of used extensively by various parties to really assess insurance companies, and those parties include brokers, banks, and government. Also, I want to point out that we're not really a regulatory entity, as some believe this, given that regulators often use our ratings for various purposes, like granting licenses in new states or territories, among others. We're just a rating agency exclusively focused on the insurance space. So the next slide, before I move into innovation, I figured I would sort of very quickly go over our overall approach to rating, just so that we can place things into context, so it may be easier to understand of just how exactly innovation fits into our rating process. And as you can see on this slide, we start our rating by really assessing the strength of the company's balance sheet strength, followed by the operating performance, the business profile, and enterprise risk management. And in certain instances, we adjust these ratings through either comprehensive adjustments or rating lift or drag. So describing really what each one of these blocks in detail would really take a separate presentation of its own. So my intent is to just go very briefly over these rating blocks, just to give you an idea of how we do this. So on the next slide, you can see that our analysis really begins with the evolution of balance sheet strength. And balance sheet strength, especially in times like these, is viewed as a foundation of financial security. Therefore, this is one of the most critical aspects of our rating. And so when we look at entities, we look at both the rating unit as well as the financial flexibility or risks associated with the holding company. We also look at the impact of ownership and structure, as well as the country risk impact on the balance sheet strength. Ultimately, through the balance sheet strength analysis, we assess capital adequacy, liquidity, reserve adequacy, as well as investment risks. And one of the primary tools we use is our model. And that's just one of the tools, as we do all sort of other analysis, like appropriateness of reinsurance program, diversification and quality of assets, liquidity, and so on. Obviously, a big portion is comprehensive review of company reserves and use of various arrangements like special purpose captives, and impact of terrorism, and so on. So in summary, balance sheet strength analysis is very comprehensive and is really the starting point of our analysis. So moving to the operating performance, without solid operating performance, right, a company balance sheet will erode over time. So we view operating performance as sort of a leading indicator of future balance sheet strength and sort of long-term financial stability. And in essence, we look at all sorts of operating metrics from premium growth, which can be either good or bad in insurance, to change in reserves, underwriting profitability as measured by various metrics like combined ratios and various return measures. Generally, what we're looking for here is the company's ability to have a sustainable performance with sort of low volatility. And we don't look operating performance in isolation. We do a bunch of benchmarking against the appropriate set of peers and so on. So on the next slide, after we sort of reviewed the operating performance, the analysts really sort of moved to assessment of business profile, which is another really sort of a forward-looking indicator which can impact the ultimate financial strength in either positive or negative way. And really there are 8 major areas or subcomponents that we look at, as you can see on this slide, from market position to pricing sophistication, product risk, degree of competition, management quality, and so on. In general, if you look at our coverage universe, highly rated companies tend to have strong balance sheet strength and solid and consistent operating performance. But what really sort of distinguishes the highest rated companies, or top of the top, from the lower end rated insurers is really the strength of their business profile, which typically translates into a defensible competitive advantage. And then moving to enterprise risk management slide, or ERM, in this building block, our really main objective is to understand both the development as well as implementation of insurance risk management framework, and to understand the insurance risk management capability relative to its risk profile. Again, a big topic this week in our conversations with insurance companies. So we look at the way organization quantifies risks, how they set the tolerance for such risks in relation to the overall corporate objectives, and really sort of how they manage such risks in light of those objectives. Ultimately, our view is that those organizations that have appropriate ERM will be in a position to preserve and build its balance sheet strength and sort of perform successfully over the long term. And those that do not have proper ERM may place their balance sheet strength at risk. So on the next slide, in conclusion, the way the rating process works is we sort of start with the balance sheet rating, as this is really the cornerstone of our analysis. And then we move our analysis to other building blocks to assess sort of their ultimate impact on the balance sheet strength, as you can see on this slide. So with that, on the next slide, moving to innovation. So in trying to answer the importance of innovation, it's really important to highlight structural trends taking place from demographic shifts to climate-related trends to advances in technology, which can sort of ultimately have an effect on the balance sheet strength of the insurer. And sort of, I'm a little bit more technology focused than most of my peers at AM Best, and it's really that focus that I have in terms of the changes that we're experiencing at the moment is sort of what led me to have conversations within AM Best, and this is sort of how this initiative was really born. I mean, just the ongoing digitization of the world that's enabled by explosion of data and exponential growth in computing power and advances in more sophisticated machine learning techniques. I mean, these are all very fascinating trends, and really the speed at which all of this is occurring has a potential to sort of transform so many facets of the industry, right? But ultimately, just to make it clear, we do view both non-technological and technological-related structural trends as factors that are driving the importance of innovation. So moving to the next slide. Innovation. Why is AM Best, why are we doing innovation now, right? Discussing company-specific innovation is really nothing new for AM Best, right? In our rating committees, we always talked about companies' innovative strategies, from innovative capital deployment to new product rollouts to innovative uses of technology like telematics, for example. So the analysis of innovation and its impact has sort of always been part of our rating process. And under new methodology, it does reside within the business profile block. And if you really think about it, I mean, we had innovation since, since the Stone Age. And innovation existed in insurance industry for thousands of years, beginning with Babylonians and Chinese trying to find ways to distribute risks in early monetary economy, right? Or even if you place the beginning of insurance with Lloyd's, in any event, innovation as a concept is not new, and AM Best has been doing it implicitly for decades. So why are we trying to separately assess innovation now? And a big part of the reason is this accelerated nature of change that our society and economy is experiencing that I mentioned earlier. The changes are really not occurring in linear fashion, but an accelerated pace. And in some instances, like in technology, these changes are occurring at an exponential rate. And you see evidence of this, the way the digitization of the economy has disrupted many industry verticals, like sort of what Google did to advertising, what Netflix has done to Blockbuster, what Uber has done to transportation, and so on. And this really all happened in a very compressed period of time by sort of historical standards. And there are really some really fascinating changes happening within the insurance industry, right? From the way insurance-linked securities, along with third-party capital, sort of transforming the reinsurance sector, to potential changes in distribution models and product strategies driven by sort of changing consumer tastes and preferences, especially among the millennials. And sort of the digitization of the world is really generating entirely new exposures, as we can see from ever-growing importance of cyber. And the accelerated pace of technological change and continuous improvement in AI, coupled with big data and other technologies, really have potential to significantly just transform the space. And we see evidence of this transformation of the industry around us as illustrated by, in a certain way, by explosion of insurtech companies, a lot of which may not be around for too long, if we're being honest, but they may be an early sign that a significant change might be coming to an insurance space. But really placing everything aside, everything that I just said, if I had to pick one, the most important catalyst for our effort in developing this innovation criteria really comes from the industry itself. According to our survey that we did, 87% of industry sees innovation as extremely, very, or moderately critical. Only 1% of companies in the insurance industry do not see innovation as critical. And so given these trends and sort of industry's view of increasing importance of innovation in a times of accelerated change, we, AM Best, we decided to be proactive in addressing these trends by sort of highlighting this particular aspect of our criteria. So on the next slide, you can sort of see—
Edin, can I just
yes.
jump in there with a quick question? And really what's spurring it is some of the news that's hitting the wire right now, especially around some of these young insurtechs that have started off really promising but are being significantly impacted by the events of what's happening right now. How much of your analysis really looks at product risk? And when there's a new product that comes out, let's say one example I'm thinking is a renter's insurtech that I think had rental reimbursement coverage built into their product. And now that the economy is going down, it's going to be a lot of people that can't pay their rent. So that company's going to be really affected.
That's a great question. And we don't really rate any insurtechs because a lot of them, again, are sort of in this experimental phase. And if I had to guess, they sort of would not necessarily rate the highest because the fact that they're early on in this experimental phase. So we really don't rate them, but you point to a great question, which is this risk. And I'll get to this later on in the presentation, really. Insurance industry has been slow to change, right? And has been slow to innovate. And you can't really blame them. I mean, there's a good reason for it, given its specific role in the economy and its fiduciary duty to policyholders, right? So a lot of these traditional companies kind of move slower precisely because of those risks that you've just mentioned, right? Versus insurtechs kind of move faster. And that's certainly something we would consider, but we just haven't rated them yet. And if you look at it, there are very few risk-bearing insurtechs, right? A lot of the insurtechs, majority of them, vast majority actually, is sort of focused more on supporting the insurance space through their products and services and helping insurers become better and more agile. But anyway, so with that, on this slide, you can see sort of the timeline of our innovation initiative. So it has been quite a process. We officially started back in 2018 when we surveyed the industry. We did a special report. And then we had 2 different comment periods. And we really wanted to open this up for the industry, right, to comment on, because if you look at it, it's very qualitative. And it's something very new because nobody's really doing it on the rating space. So we really wanted to incorporate as many comments as we could to sort of create this. And they were not just from the industry, but also from other various parties, including academic institutions. In fact, we received some very valuable comments from Dr. Phil, who I believe he will be presenting next. So on March 5th, we officially launched the innovation criteria. So with this slide, I really hope I was able to cover sort of the rationale as to why we're doing it now and a brief timeline of our process. And then the next few slides, I hope to actually explain sort of how we go on assessing and measuring innovation. So on this slide, if we look at innovation on both an absolute basis, as well as the innovation efforts may affect financial strength of the organization. So this probably sounds very confusing, but in essence, the first part of innovation analysis really relates to an absolute score that tries to capture the company's overall level of innovativeness. And then the second step is to try to apply innovative efforts and see how these efforts may potentially impact the financial strength of the organization down the road. So maybe the best way to illustrate what I'm trying to say is through an example. For example, a company that's not very innovative in a highly competitive, for example, let's pick personal auto space, may be penalized more for its lack of innovation due to the market it operates in. As you know, personal auto is highly competitive with high levels of optimization, and it's sort of very exposed to some of these exponential trends we talked about before, like telematics or changing consumer behaviors. So a company that's not innovating in this very competitive and fast-moving line of business may find themselves in increasing disadvantage and sort of adversely selected against compared to the leaders in the space. And then a player in a slower-moving industry, may not experience as big of a threat to their balance sheet strength by not being innovative. So on the next slide, for the rest of the presentation, I'll really try to focus on sort of absolute rating of companies' innovative efforts. So on next slide, slide 15, so the first step in the evaluation of innovation from AM Best perspective is defining what innovation is. So AM Best defines innovation as sort of a multi-stage process whereby an organization transforms ideas into sort of new or significantly improved products, processes, services, or business models that have a measurable positive impact over time and enable the organization to remain relevant and successful. And so these products, processes, services, or business models can either be created organically or adopted from external sources. And there are several key aspects to AM Best's definition of innovation. First, innovation can take many forms, right? It's not just limited to a particular type of innovation or technology. The definition also allows for flexibility regarding the source of innovation. For some organization, innovation through adoption may prove to be the most appropriate path. Additionally, while very important, innovation is not necessarily just about technology, obviously. There are many non-technologically driven ways to innovate. So in areas such as innovative products, there are many carriers that have done quite well for themselves through product innovation. And second, AM Best expects the output of innovation process, whether that's significantly improved product, processes, service, to have a measurable impact. And that's really something we look for. Obviously, failure is an expected part of any innovation effort, but companies receiving the highest innovation scores will have a demonstrable success in innovating. And it's also important to know that innovation is a dynamic and ongoing process, as well as a long-term commitment. Companies receiving high scores will be those that treat innovation as sort of a part of continuous cycle of organizational growth and development, and that really successfully integrate their innovations within the organization. And typically those companies with the highest scores should have a long history of industry-leading innovation. So on the next slide, moving to the actual scoring, our evaluation of a company's innovation potential really takes an input-output approach. And it's really based on two elements, right? First is the innovation inputs, or the components of company's innovation process. And then second is the innovation output, or the impact of the company's innovation efforts. And then the resulting innovation score is really the sum of these two evaluations. So on the next slide, we will discuss various components of innovation input score. So moving to the next slide, in effect, the evaluation of companies' innovative inputs is really assessed by four subcomponents, which is leadership, culture, resources, which is allocation, strategy, management, and then processes and structure. And these subcomponents capture both the company's innovative capacity or the resources the company is dedicated to innovation, and also its potential innovation ability, or whether the company can leverage sort of its available resources and create value. And each one of these subcomponents that you see on the screen is really scored from 1 to 4, 1 corresponding to the lowest assessment and 4 to the highest. So moving to the next slide, and our first input category, or leadership. As you all imagine, leadership is a critical and very important component, and it's often one of the major drivers of innovation success or cause of innovation failure. And if you really think about it, has a direct influence on all of the other subcomponents in innovation assessment. It is really a critical block. And so what are we really looking for in leadership, right? we expect that innovation will have the sponsorship of top management and support throughout the organization, including board participation, but also significant involvement by everybody, including the middle management. The companies, in our view, the companies that successfully innovate typically benefit sort of from a buy-in at the senior management level, and we look for this evidence in various places like corporate mission statement. And AM Best feels that leadership should have a strategy communicated to employees that sort of specifically states the innovation strategy, but equally importantly, why is the organization pursuing this strategy? As you would expect, good leadership is supportive of cross-functional collaboration that sort of identifies, develops, and implements new innovative ideas. And to us, or to AM Best, the clear quantification of goals by leadership is essential so that all parts of the organization really understand what the results should be. And this to us is important, since by embracing and fostering a sort of a culture of innovation, leadership can generate sort of a high level of interest of buy-in through consistent communication. Ultimately, in our view, strong leadership really empowers all employees to be the change agents. So at the next slide, we have culture, which is another self-assessment block. And like leadership, culture, in our view, can either stimulate or suppress innovation. And as you would expect, the organizational culture that inspires innovation allows for risk-taking as well as possibility of failure. And as I was mentioning earlier, clearly for insurance space, this is a very fine line to walk, right? I mean, it's hard to blame, as I said, the insurance industry sort of for being conservative, just given their role in the economy and the fiduciary duty policyholder. But having the processes in place where the insurance companies can take well-calculated and controlled risk, in our view, can encourage innovation. And companies that receive the most positive assessment approach the innovation process sort of purposely and systematically, and can demonstrate that their innovation initiatives are really integrated throughout the organization. And the culture of these companies fosters sort of ownership and transparency, while also sort of encouraging cross-functional knowledge sharing. And for those companies, innovation is typically part of the enterprise corporate mission and is embraced as a key for long-term success. Tolerance for risk-taking as a part of the culture is well defined, with failure an acceptable option, but with a process in place, and this is something to look for, that manages these risks effectively. And then the companies with innovative cultures tend to evaluate both internal and external innovative solutions as sort of a part of their regular assessment of customer needs, their market conditions, and threats to their business model. Because leadership often drives culture, in our view, an enterprise is unlikely to have a high culture assessment if it does not have a strong leadership. And then the next slide, we'll move.
Actually, before you go ahead, we spend a lot of time on leadership and culture. So I thought it just might be a good point to solicit. Are there any questions about everything that he talked about? He covered a lot of terrain on the scoring, and then particularly with his comments about leadership and culture, it might be worth a moment or two to stop for questions. Okay.
Hey, Charlie.
Yeah.
Yeah, I would, as you were asking, I was same time thinking about, of all these different attributes, culture seems to be the one that's most critical in that it's something that's sustainable. If you have, the culture for innovation, that's something that, will transcend change in leadership or any of the other attributes. So I almost feel that culture is one of the most significant attributes. Any thoughts on that?
That's a great question. We went back and forth on well, they're equally weighted in our, right? Both culture and leadership are sort of equally weighted, meaning they're equal parts of the input. But that exact question that you just asked, we went back and forth quite a bit of sort of, is really the cultural that drives the leadership, or is the leadership driving the culture? And we have some great panelists here that might have some interesting opinion on this. But in our view, and we sort of see leadership setting the tone of the company, especially some of the companies where you had the leadership for, and I'm not going to name companies in my portfolio, but we have companies that had a fairly stable leadership for decades that really sort of created a culture of a certain type of a culture that sort of drives innovation. And then I've seen examples, especially in M&A cases, where a new entity takes over the existing operations, and then the new leadership comes in, puts its own people in key positions, and then they kind of start changing the culture within that entity. And that's really, given my prior background in M&A, really, if I think of the risk, one of the biggest risks to M&A is this cultural risk, right? When you have two clashing cultures merging, and the winning acquiring culture acquiring a different culture, there's a risk of changing that entity and sort of what made it great by sort of removing that culture and instilling the new culture within the place. And that's one of the big risks in M&A transactions. And therefore, this is why I sort of selected sort of leadership as obviously they're equally important, and it is debatable which drives which, but I've seen instances where when culture changes due to the change in leadership, the organization sort of transforms into something else.
That makes sense. Thank you.
And
this is
Phil,
Josh,
I was just going to jump in on that and commend you for having both leadership and culture. At an academic institution, they often try to work out which drives which, and the academics often have big debates, but the fact that you've put both in there, I think is really important. And it leads on to the other two factors you're going to cover as well. But I was going to say, big picture, I look at a lot of sectors. At MIT, we do a lot of innovation. It's interesting, how often innovation driven by digital technology can really disrupt an unsuspecting sector. So it's good that this sector, both with the participants here from the IU board and you as their rating agency, are looking at this. But secondly, I really want to commend you for your work in AM Best generally, for actually taking this nebulous concept of innovation seriously and trying to help us get our arms around it in terms of a definition and some metrics. And these things are never going to be perfect, but I think you've got all the right buckets in there. I'll touch on this briefly in my session, but I just wanted to commend you for your efforts in this area.
Thank you. That makes me feel a little bit better. As you said, it's typically I shied away from dealing with qualitative things, being a finance and working in capital markets, and but just given my interest and in this particular topic, it was very nerve-wracking for me to really work on this, given the qualitative nature of so many aspects of it. And for that, I'm very thankful for your comments and for your suggestions, as well as the suggestions of the industry. So with that, we'll move to
actually,
Edin, I'm sorry, I have one more question.
I had another question.
You go ahead. I'll ask mine.
So I had two questions actually. One is, this is Josh Hollander. So I come at it as from a little bit different perspective. I now work in executive recruitment, but I have prior operating experience. I've been through a fintech startup. I've worked for large global organizations as well. So I have a little bit different perspective, but haven't worked in the insurance industry in the way some of the other folks on this call have. But at any rate, one of my observations is that I think some of the carriers in the industry that most people would recognize as being innovative, part of how they've done that is through standing up parallel organizations or creating transformation efforts that sort of come from outside the standard operating lines of business, and have made conscious efforts, whether it's creating separate campuses away from the main corporate offices, where they sort of set up a whole different culture. So one question I have is, you talk about the message of driving it through the whole organization, but for some of these companies that have been around for, a century or more, and the culture, the prior culture is so ingrained, I think, there may, I guess, how do you look at the initial stages of the process of driving innovation and value that? That's one thing. And then the second thing goes to your reference having a background in M&A. a few companies have made some splashes by acquiring insurtechs. Some would argue that some of those purchase prices have been highly overvalued for what they've gotten. But, that some of them have been used as a signal, an attempt to signal to the market that the company wants to drive innovation. And so I'm curious as to how you value that as well.
Absolutely. I'll start with the second one. So acquiring insurtechs, obviously that's within the resources sort of input category, where companies have clearly done that. And they may get some credit if the analyst feels that that particular acquisition drives their strategic objectives. But, and I'll get to this later in the presentation, it's really hard for a company to have a high innovation score by just having these inputs. And in this particular case, having the resources to acquire these entities, which is great, but ultimately they have to show that in their output. They really have to quantify the impact of that on how that has lowered their loss ratio, or how has that helped them develop or introduce a new product that's driving the top line growth, and so on, right? So really, the proof of it is sort of in the output. So the short answer is just acquiring an insurtech is not really going to drive the innovation score up that much. It's not going to be impactful. And I apologize. You might remind me the first question. Is it
just some of the organizations that have, if you have a culture that, as you said, by the nature of the industry is risk averse. You talk about leadership driving a culture of innovation throughout the organization, but sometimes for companies that are at the beginning stages of that, to try to move everybody at once is difficult. So they stand up transformation groups, outside of the normal business lines.
Yes, absolutely. We'll look at it. A lot of companies do have certain areas within the companies. They're sort of X labs, or whatever you want to call it, where they experiment. And also we'll look at companies' participation in accelerators or incubators or other areas, and we try to assess their efforts both holistically across the whole company, but also with specific parties that are driving it. And it's really down to the analyst's judgment on really how to judge that based on a specific company situation.
It's Bill Keogh here. Can I ask a question?
Sure.
Yeah. So I was at the preview review a year plus ago when this was rolled out, and I was a huge fan of this when I first heard about it, and there was a little bit of rolling in the eyes in the audience about a new criteria. Mm-hmm. What does it look like now, and how has this been? What kind of reaction are you getting from your clients on the?
Yeah, no, that was my biggest fear, to be honest, as I was working on this, because just due to the nature of our ratings, we get a lot of attention from the industry on anything we do, especially on anything that involves the rating process or the criteria, right? So that was my biggest anxiety was coming from that place. But I guess even to me, surprisingly, overall, and the comments that we've received in terms of suggestions from the industry, and we received hundreds of comments, especially in the first round, were, I would say, overwhelmingly positive, more so than I thought, right? And of course, there were some negative comments, and you already know what kind of negative comments you would expect, which is this is too qualitative, or how do you consistently apply this across analysts for every company? So that was certainly a concern, right? So and this is why we really kind of sort of had this effort for 2 years, and we placed it out in public really for almost 2 years, so we can get those comments, we can get those concerns, and then we can get input from the industry to sort of work around those concerns and see how we can best address them before we finalize the criteria. But since we have finalized it, I at least from my perspective and based on what I've seen, it's been overwhelmingly positive. So far, maybe they're telling me one thing and they're telling other people the other thing. It could be a case of that, but from my perspective, it's been very positive, even more so than I actually expected.
That's great.
Edin,
Edin, can I ask a question? How do you account in your methodology for executive participation in the innovation process itself? Because I feel like that is the thing that makes the difference to the culture. It's the participation rather than being a consumer of the product, being actually involved in driving it, having executive stakeholders at stage, vetting and participating. That sort of changes everything. Do you account for that in your methodology?
Yeah, so what we try to do is sort of concrete examples where leadership sort of has demonstrated and encourages innovation. And to really get like a high score on that, leadership really has to sort of demonstrate that it actively encourages innovation throughout the organization at all levels. And this might be different from company to company, but really we'll have a discussion with the company where we'll walk through specific examples on what they have specifically done to promote that. And then also track record of that they're proven through their past initiatives to have sort of the expertise to develop and implement an innovation strategy. So it really is company specific because there are various different strategies that companies approach this.
And if I could just jump in at this point, getting back to the culture and leadership aspects of this, one of the ways I think about it is, there's a lot of things that are really important for innovation, senior level sponsorship, budgets, whatever. But it's possible, with bootstrapping to get innovation done without a budget. It's possible through ground up innovation to get change to happen bottom up versus top down. It's maybe not as effective. But ultimately, from a culture perspective, when you're talking about making change, this is like one of the things you can't get over unless you've got a good culture, right? It's one of the things that's most difficult to get by, especially as you're starting up. Like it's so, and there's the classic statement, right? Strategy or culture eats strategy for lunch. This is definitely one of those examples. If the organization isn't set up for change and you have great top-down support, that's one thing. But if the bottom up isn't ready for it, if you got a heavy middle management, whatever, it's going to be hard for that change. Like culture will definitely represent a huge hurdle. So getting back to the points around importance, I definitely think culture rises to the top.
No, absolutely. Leadership and culture are driving innovation. There's no question. I agree from our perspective as well.
And then just around the question of how it's been received, if I could just tell just a little story about, with Amica, one of the things is first, as soon as the criteria came out, with a small group, we developed our own self-assessment. We said, hey, here's the criteria. Go through and figure out what you think we're going to score. And this was back in April, I think, at some point, so about a year ago. We got our first ratings. It was right there. There was no disagreement between what we thought we were going to score and what we actually scored. So as far as that's concerned, from our perspective, the score really did accurately reflect where we thought we were. So that was great.
That is not my experience.
Well, yeah, and I can understand why. We had some challenging conversations during that self-assessment, and we had to kind of be honest with each other. But it made it easier for me to have that conversation because I had established criteria where it's either 1, 2, or 3, and it's not just a discussion. It certainly helped.
So Adam, does the fact that your internal assessment has now been validated by AM Best, does that help you going forward with things that you want to do?
Yeah, and absolutely. Like we're in the phase now we look at, okay, well, how do we get to the next tier? How do we keep moving this thing forward? And what the criteria does is it gives us a way to look at and say, based on how we're scoring, if these are 3 things we can do in this category, it's going to help with our score next year. Yeah. Right. So it even helps from an overall innovation strategy around maturing the practice and trying to develop a plan moving forward. And then, I think I want to end here with a question for Edin, because something like culture is impossible to get really a good read based on a slideshow or something like that. So I'm really interested in things like this, how you guys actually get in there and really kind of get a good assessment on culture.
It's also a learning process on our end as we develop it, right? The sort of I guess the main things that we look at in terms of the culture, we'll look at levels of participation. The company's employees, how are they involved in innovation initiatives? Whether the company has sort of an organized process that encourages employees to participate in innovation, right? So if they have that in place, and if they can demonstrate that employees understand and use these process steps. And then we'll look at embeddedness, whether innovation projects, are they siloed? Is there a transfer of expertise and insights? We generally take a look at if the company has a sort of enterprise-wide sort of a vision of outcomes from innovation project, and if there's a coordination between business units and leadership, and whether the business units sort of demonstrate ownership of the innovation processes. And then obviously failure is another thing, and how companies deal with failure, and if they can link successful innovations to knowledge gained from failed innovations, and can provide an opportunity for sort of cost-based rationale for abandoning certain initiatives. And then innovation incentives is another area we'll look at, if there are sort of clear links between enterprise innovation goals and performance incentives is one thing that we'll look at. On the communication front, we'll look at at both internal and external communication about innovation, if it's robust, and if there are metrics in place to track innovation progress, right? Do they have these internal metrics? And then agility, has the company successfully sort of pivoted to meet challenging market conditions and sort of consumer behavior in a timely manner, right? And you can see examples of this through recent history of the company, has this agility, cultural agility to sort of shift through these changes as well. So those are some of the things, but it's a big topic, and it's probably going to be a big presentation on its own.
All right. Just in the interest of time, we have about 15 minutes, and I think you have a lot to cover. So I think maybe go over the criteria briefly, the part you haven't covered. And then I think the group wants to hear a little bit about the results, like what you're seeing.
I really want to spend more time on the results, because that's new, and we just sort of done that. So resources, really, we sort of talked about it. We will look at companies' resources, their allocation strategy, and so on. And processes and structures is important. So we, as well, we look at, organization optimize the process structure, promote organizational intelligence while avoiding innovation silos. So that's important as well. So on the next slide is really how the output score works. In essence, we multiply results by 2 and level of transformation by 2, and to bring it, so because we want to, in essence, we're looking to equal the outputs same as inputs. So let's see, on page 25, maybe we can go to that. So one of the most important things we look for is sort of the tangible benefit of the results from innovation-related efforts that I spoke earlier. And really, I really do want to stress that this benefit must be quantifiable and measurable, right? And whether, as I mentioned earlier, this is linkage between loss ratio and use of telematics or variables, or top line growth due to new innovative product, we have to see that link in the output. And so the next slide, the concept of transformation. So company innovation initiatives may be impactful, right? But they may not be transformative or really even allow the company to remain relevant. So I just spend a second on this, because this might be something that that many people don't consider. So for example, a company may adopt innovative approach to, for example, let's use an example like cloud computing to gain the speed to market, or use big data to enhance the submission processes, right? So while these actions they've implemented in innovative ways are considered sort of forward-looking and may have positive impact on results through lower loss ratio or efficiencies, the transformation would not necessarily be at the highest level, since many other companies are also doing exact same things in the marketplace, right? So only those companies in general that have sort of best-in-class output are eligible for high transformation sub-assessment. And I just want to point out that the high transformation scores are very hard to achieve, because transformation encompasses initiatives that create a significant value through sort of a superior business model or significantly enhanced growth opportunities through various barriers to entry, right? So given just how rare the true transformation is, especially in our industry, we expect that many companies would score high on this sub-metric. And I just want to point to that. So on the next slide, before we get into results, these are the descriptors, right? And we kind of changed them to make them a little bit more neutral sounding, because we had non-innovator and people didn't like that, so we kind of took those comments. So we have minimal, moderate, significant, prominent, and leader. Minimal being the lowest assessment, leader being the highest. And I just want to point out, though, that we do not anticipate publishing these ratings or descriptions publicly for the companies for the time being. It's something that may change in the future. So on slide 29, again, this just shows you where innovation fits in. It's within the business profile. And I'm sorry, I'm flying through this because I want to get to the last part. And on slide 30, this is where really innovation fits. So historically, business profile had sort of 8 components, as you can see. And so innovation is now the 9th component. And in essence, the reason why we have it within the business profile is really our belief is that lack of innovation will ultimately lead to sort of erosion of business profile over time. And this is ultimately how we plan on capturing the way innovation, or really the lack of innovation, can either sort of enhance or erode the financial strength of an insurer. And that's why we have placed it there. And so we can go to the slide 32. So this is, you can see a preliminary distribution of scoring. Now, before I get into it, I do want to stress that these findings are based on preliminary results, given that in many instances, analysts had to rely on early discussions to sort of reach their conclusions. But having said that, we had some very interesting results. For example, as you can see, only 1% of insurance companies have scored in the highest possible category or leader, while 17% are in the lowest or minimal category. And as you can see, the biggest concentration is in the second lowest or moderate category, where really half of all of the companies that we rate are concentrated. But this distribution was actually largely in line with our expectations, given the state of innovation in the insurance space, especially compared to some of the other verticals out there. Another general observation was that the insurers that scored higher on their input scores than their output scores. So a lot of insurers really scored higher on the input score than the output scores, because it's really hard to get a high score on the output score unless you have demonstrable benefit from innovation. In addition, as a part of our research report, we conducted various benchmarking exercises, right? So we kind of looked at and compared innovation scores of companies with various characteristics of companies, including sort of their overall rating, their operating performance, their financial size category, and so on. And unsurprising to us, we found that the companies with the higher overall ratings generally had higher innovation scores. And this makes sense, as innovation can often sort of lead to a competitive advantage, which can strengthen the company's positioning in a marketplace. And in addition, we found that the companies that have a particularly high output score tended to have a high innovation score. And again, as you can imagine, this was expected, as generally only those companies that have well-developed inputs can achieve high outputs. And in addition, as I mentioned, we really weighted the scoring in our criteria in a way where it's unlikely for a company to achieve high innovation score unless they have tangible output. So I do want to add, though, maybe a little bit more color, that as we analyzed all of this data, there were very few common, there are some traits that sort of differentiated these different buckets, right? So through this process, it became apparent that the most innovative players, those in the leader and prominent categories, were able to sort of differentiate themselves by credibly quantifying the results or the output of the innovation efforts. And then leaders, or the top 1%, sort of further distinguish themselves by often being innovative sort of first movers within the insurance space, and were the timeliest in responding to market pressures, later sort of offering new products or solutions for emerging needs. And leaders typically had higher transformation scores. And then the companies that we assessed as significant, which is 23%, they typically recognize the need to innovate, but frequently had to develop sort of these deep connections between their inputs and outputs. And then companies that we deemed as moderate are really often just beginning to develop an innovation strategy, often in reaction to a competitive pressure. And finally, the companies we assessed as minimal have no innovation strategy and are often companies that actually, in most cases, not all, but in a lot of cases, face the least amount of competitive pressures. So with that, on the next slide, you can see the lines of business as we scored that sort of we assessed as the most innovative. So as we were, it's really interesting, as we were conducting innovation ratings throughout our universe, we noticed certain themes relating to innovation. We noticed that the lines of business that faced most competition or had most structural or technological changes also had the most innovation. So if I had to pick one theme, then I would say that we saw this validation of the phrase that necessity is the mother of invention or innovation in this case. And consistent with this, the most innovative lines of business that we identified were reinsurance, health, and auto lines of business. And if you look at these three lines of business, they all underwent quite a bit of change that has forced these lines of business to become more innovative. So for example, I think we all witnessed how structural changes, such as introduction of insurance-linked securities, have sort of changed the reinsurance space over the past couple of decades and really have forced the reinsurance players to become more than just capital providers. And in the process, that really spurred innovation in the reinsurance space and also consolidation, as you have seen as well. Similarly, health also went through a structural changes that created pressures with advent of Affordable Care Act, for example. But in addition to these structural changes, the health space is also getting exposed to a lot of these emerging technological trends, like changes in consumer tastes and preferences. In addition, exponential growth of some of these emerging technologies like big data, wearables, advanced forms of machine learning, also creating a lot of opportunities for the players in the health space. And then auto is perhaps one of the lines of business that is most exposed to the just pure emerging technological trends, given its relatively sort of low complexity. And we're seeing an uptick in trends like increased use of telematics and process optimization, especially in claims areas. It's really interesting space. And the companies that are leveraging these emerging technologies sort of in most innovative ways in auto are really sort of, we're starting to see them gaining competitive advantage in terms of better risk selections and better customer satisfaction. So that's a very high level overview of our results. And with that summary, I think I covered most of this. It has received a significant interest from the industry. Generally very supportive, more so than I thought, of the need to highlight the importance of innovation. One thing, that AM Best believes that importance of innovation may potentially increase over time, and no rating changes are expected at the time, since all of this has already been implicitly baked into higher ratings. We're just making it more explicit so that we can create a better framework to measure it. So that's really all I had, and there are more questions.
Any questions about the results? Anyone?
So if you're not going to make any rating changes, what's the motivation for somebody to not only innovate, but demonstrate to you that they are innovating? Is it likely that in the future it will have an impact on the ratings?
Right, it already has an impact on the rating. It should have had an impact on the rating since it has been done implicitly, right? So we always sort of talked about innovative capabilities of companies in the rating committees before, but the process was not formalized really, right? And all we have done through making it explicit is formalizing the process. And the reason why we, made it explicit and formalized the concept is because we really wanted the industry to come out and provide their comments, which they have, to sort of try to create this framework to measure it. Since we do believe that going forward, innovation may potentially become increasingly important differentiators for insurance companies due to some of these structural changes happening in our economy.
Thanks.
Do you have any time frame? Do you think that you're gonna, is the plan to, I know you said you may or may not, publish the individual innovation score ratings? Is that as
Yeah, so that's up for debate. Potentially that we might start sharing that. I am personally a little bit hesitant to share those preliminary scores with the public until we sort of have few rating cycles with the companies, and until analysts become sort of more familiarized with this approach. So my preference is to hold off on making this public till this process takes few rating cycles.
How much transparency do you have with the existing rating process and the subcomponents that you showed us? Do those get divulged or not?
Yes. So what we do is obviously with companies, or we are completely transparent, or we should be completely transparent on every aspect of every sub-profile component. But in terms of publishing, we do publish individual scores for each subcomponent, meaning business profile, operating performance, balance sheet strength, and ERM. So those are public. The subcomponent scores of each, and there are many subcomponents, not just within the business profile, but also balance sheet and all of the other ones. We don't make those public, but we disclose those to the management when we have conversations with them.
Got it. Thanks.
all right? Any other questions? We have time for maybe one more if anyone has it. If not, we'll move ahead.
If there aren't any other questions, Edin, I'd love to hear from you, your thoughts about where you think this is going to go over time, how you think it's going to evolve in the future.
How our innovation rating process will evolve?
Yeah, just the scoring criteria. Do you expect it to change and evolve over the years, or?
I don't expect it to change from its current format, but I do expect our approach to each subcomponent to get refined in terms of the asking the questions, in terms of getting the data from the company, and so on and so forth, as we're working on those things. But in general, I think the overall approach is going to stay the same, but we're just going to refine it on a granular level and make it more consistent internally across all the analysts.
All right. Thank you so much, and you're more than welcome to hang out for the next section. I think we'll take maybe 2 or 3 minute break, give everybody a chance to grab a snack, grab some water, do whatever they need to do, and then we'll come back with MIT, Phil and Anne Marie, which is we're excited to see, and we'll start that in a few moments.
Thank you.
Thanks, Edin. That was really good. Thanks.
Thank you.